Good morning, good afternoon, good evening. You're listening to Outsized Returns. I'm your host, Samuel Austin Taylor, Sam T. Search Sam T on all the social media channels. And so today we have a fantastic guest. We wanted to discuss investing today. We know that, some of the previous episodes, we've touched more along the lines of startups and real estate, and investing and financial services is particularly my background. And I wanted to bring somebody on the podcast that has specific knowledge when it comes to investing. We're recording this June 26, 2020, and a number of things have been happening in the markets, not only in the markets, but also here in the environment in America, where businesses are shutting down, unemployment has reached unprecedented levels, and a lot of people have kind of been placed on their heels from the COVID-19 pandemic. And a number of financial advisors and retail investors have a number of thoughts on their minds right now. And so today, my guest, Mike Sefscik, Director of Channel Alliances at a company called Riskalyze, is really going to explain how Riskalyze can help you and also your financial advisor, if you have a financial advisor, better mitigate the troubled waters, for the next pandemic or the next recession that comes about. So Mike, welcome to Outsized Returns, man.
No, thanks for having me. I'm excited.
Yeah, absolutely. So I know that, we've caught up a little bit and we kind of share a similar background, but why don't you tell the audience, some of the things that you do at Riskalyze and also introduce them to Riskalyze as a company and kind of the solutions that Riskalyze provides.
Yeah, no doubt. Just, quick backdrop is Sam just mentioned. I come from more of a distribution world. What I mean by that is I used to sell individual securities like mutual funds, ETFs, third-party money management, which would be like an SMA is a term you might hear now and then. I spent a lot of my time going door to door, trying to get in front of advisors to ultimately use my strategy, right? Mm-hmm. And you know this very well, Sam. Through my experience, in particular, my initial experience, Sam, with our colleague we both know, TJ, I learned a lot about the investment world and specifically wirehouses like Merrill Lynch, Morgan Stanley, all the names that you'll show up on your commercials. Mm-hmm. And during that experience in trying to position my product, one thing you always wanted to do for financial advisors was bring more value than just a fact sheet and a product, right?
Absolutely.
And one thing that I was really good at, and I used to think I knew it all, was I knew my products, I knew my fact sheets, I knew my share classes, I knew where my products were available, and I'd walk into an advisor's office and I'd say, hey, you should use my fund, and here's how you should talk to your clients about it, right?
Right.
And There was really no value add. Okay? And so it eventually led me, there was a guy by the name of Dan Roble when we were at Federated. He was a specialist who knew Wells Fargo and their internal systems and technology better than any advisor using them did. And I used to take him on the road with me in the territory and sit down with a group of advisors, and he'd spend 30 minutes going over 10 ideas on how to become more efficient with their practices and become more efficient with their trading so that they could spend more time with their clients where they should be spending their time, which is coaching their clients, from the psychological perspective, quite frankly. Mm-hmm. And I say all of that quite simply because that was sort of my inspiration that led me to this financial technology firm, Riskalyze, where I'm at today. Because when I first saw Riskalyze and I was sitting at an airport traveling, it was in a magazine, top 10 most innovative companies in finance. It caught my attention. And when I watched a quick video, it caught my attention because it spoke to me for two reasons. One, it could help me sell my product better, position it to help advisors to set expectations with their clients. But two, as somebody that was a licensed professional, Sam, right, having my Series 7, 6, 6.3, 6.6, all those, mm-hmm. Could I be a financial advisor myself? And when I saw this technology, it provided a process that could help me sleep at night, quite frankly. As you start up as a financial advisor, you usually start and spread your wings to people that are closest to you. And could I manage a book of business? Yes. But could I sleep at night? No. And when I saw this technology, I quickly snapped to me like this was what would allow me to sleep at night.
Yep.
So I don't know, if that kind of answers your question. I want to kind of give you my inspiration as to what led me to this technology. So.
Yeah, absolutely. And one of the reasons that I wanted to start this podcast was to be more educational instead of entertaining when it comes to business. I've been back on the social media channels, and I don't know if you have a Twitter account, but the former CEO of Barstools is day trading his account online and providing economic commentary about how he's better than Warren Buffett. And, he'll pull out Scrabble letters and just type in a ticker symbol and, dump $150,000 inside of it. Now, a lot of people are, entertained by that. And I would think most don't believe that that's investing. But unfortunately, I read a tragic Robinhood article about somebody that did something tremendously horrific to himself because he saw that, his margin account balance in Robinhood was like negative $700,000. And for the listeners, you can go look into that story. And so Riskalyze, what it allows you to do, and I used to use this analogy when I was a wholesaler, was allows you to have a number that really identifies where you are in terms of your risk tolerance. I use the golf analogy where, if we're on a par 5 and 5 strokes is even, we know that if I get 4, that's a birdie. And if I have 6 strokes, then I'm going in the wrong direction. And if I do that every single hole, let me take a step back. Because if I do that every single hole, that's a good golf round for me. But, if you're Tiger Woods, being 1 over for the day is really not that impressive. And, you may be out of a tournament. But knowing that on a par 5 for the first hole, having to get 6 and then a 4 to get back to even on the next par 5 is really what you need to understand. And so we can create an investment portfolio that's constructed in a way to where we know that, if you lose $10,000 or 10% of your retirement savings, you'll be fine, but maybe you won't. And that's what Riskalyze allows financial advisors to do. Now, did I explain that correctly, Mike?
Yeah.
Okay.
Exactly. I think, simplifying it even further, what it allows, it exists to help advisors really just remove the fear from the decision-making process.
Mm-hmm.
You'll hear Aaron, my CEO, talk about it all the time where investing is broken, right? We feel that investing is broken, and it comes down to really because investor psychology and the emotions associated with it,
Mm-hmm.
it sabotages investment performance, right? And then you layer in the complexity of the markets, it's just overwhelming for the end investor. So you bringing up that that Barstool guy, that's scary, right? And that's unfortunately another reason why we feel that way. So
yeah, and I think that investing is a little broken, and there's 2 sides to the coin. There's technology is making a number of businesses commoditized, and I think that the last decade, we've seen this unprecedented performance in the market. So that's made things a lot easier to do it yourself, or just hire a robo advisor, or buy a few different portfolio positions and kind of set it and forget it. But to that same token, 15,000 baby boomers are retiring on a daily basis and only have 1 year's retirement saved. And so I think a lot of people are caught between this wide space of I can do it myself and I don't have enough to really stop working. And I think that if we can kind of put our egos aside and hire a professional, maybe we can, kind of bridge the gap a little bit, so to speak.
Yeah. So I think you're on point. And you mentioned the term robo, right?
Mm-hmm.
And when I think of, robo, I think, emotion obviously comes to mind, right?
Mm-hmm.
And emotion shouldn't play any part, but the reality is that they do.
Yep.
And I can't imagine the COVID crisis or 2018, right? The market crash. I think people forget that actually we experienced almost something identical to what we just experienced this year, right?
Mm-hmm.
And if you need a coach or somebody to call, I just don't know if a 1-800 number will cut it, right?
Exactly.
In a call center. So, I think you nailed it. Like having an advisor is crucial, and we are really big believers in that from a Riskalyze standpoint, at least.
So the web address is Riskalyze, RISKALYZE.com. Now, this is not available for individual investors, correct? Only financial professionals, right?
Yep.
Okay, that's what I thought. Now, what would be the best way for advisors to implement Riskalyze in their practice? I think our conversation should really help some of these listeners ask their financial advisors, hey, why aren't you using Riskalyze? Or are you using Riskalyze in my portfolio? And then, maybe the advisor doesn't know what it is, but he needs to look into it.
Yeah. So from an advisor, actually, you can look at it from both angles.
Okay.
So you said it on the front end. So just to recap what you said, what Riskalyze actually does is we get a client's risk number, right, through a quantitative questionnaire built off of this Nobel Prize winning work called prospect theory, where you get a risk number at the end of it that says on a 1 to 99 scale, you are a risk number 50, right?
So 50 is in the middle. If I'm 87, I'm pretty aggressive. If I'm 25, I'm pretty conservative.
Correct. The market, I think, right now is a 77. So that updates every night as well. Okay. So the market's a 77, just for context. So if you're about a 40, you're comfortable taking about half the risk of the overall market. Okay. My wife and I are the exact same age, by the way. I'm a 92. She's a 35. So that brings up a point.
That's a whole different dynamic, professional and, also a spouse. Like, that's interesting though. That's pretty wide.
And that's where, like, the technology itself, and maybe some of your listeners have experienced this. Some of these questionnaires that you might walk into will ask you very subjective questions, and how risky do you think you are, and that type of thing. What our technology does is it takes the semantics out of it, and it gives everyone their own individualized risk, because we don't care what your age is, or just because you're young doesn't necessarily mean you want or need to be aggressive, and just because you're old doesn't mean you want or need to be conservative, right? So we can take that and rip that out of the equation, and again, empower the individual. But ultimately what happens after a client or a prospect gets their risk number, an advisor is able to say, well, let's bring in your current portfolio and let's see what that's scoring on a 1 to 99 scale. Now, the catch here is that clients are finding out 80% of the time, more than 80% of the time, that they have far more or far less risk than they realize. So you want to be a 50, but your portfolio right now is a 70 or it's a 30. So it's eye-opening. It's an eye-opening conversation that, one, it helps the advisor to educate the clients in an expedited format.
Yep.
But two, for the client, it's providing an experience that they've never had before, right? And that's what I always harp on when I'm out and presenting in front of advisors. I talk about the experience, it's a risk-first experience, but it's something they can take back home with them.
Yep.
And there's a story I always share as I'm presenting to advisors. I say, there was an advisor in early 2019. I was sitting with him in Chicago at dinner, and he said to me, Mike, I've been in the business for 25 plus years. I adopted your technology and platform 2 or 3 years ago, and it changed my practice. It changed my life.
Had to.
Yeah. And I said, well, tell me more, because, this will help.
Right.
And look at the holiday crash last year, right? And this was 2018. It goes from October up until December 24th. The markets crashed just like they did in COVID, right? He goes, I really didn't get any phone calls from my clients. And he goes, better yet, on the 26th, the 27th, the 28th of December, my clients were calling me and I got 6 referral leads.
Yep.
Right. He goes, that told me a number of things about my client. Number one, they are identifying with my process rather than being emotionally tied to me as an individual, right? Going back to that experience. Number two, since they identified with my process, they were focused on my worth. They knew what I brought to the table. They weren't just saying, "Oh, that's my financial advisor. I don't know exactly what he does."
Right.
This is what he does. Here's how the risk number works. And number 3, they were articulating my value to others at the dinner table over the holiday, right? Mm-hmm. They were advocates for what I do. And that is the number one thing our platform does, is it kind of bridges that gap between, everyone speaking a language that they understand. Because you and I, Sam, we hear the industry jargon all over the place, and I still don't understand 99% of it. Just being my mom and pop or my dad walking into a meeting and trying to have that conversation. That speed limit line, the risk number, bridges it. So I'll leave it at that. I hope that makes sense.
Yeah, no, it makes total sense. And I think what investors need to realize is that you can't completely eliminate all risk from the market. I mean, you could take your life savings and put it under your mattress, so to speak, and there's a risk associated with that. It's called inflation risk, right? So you're taking risk if you have money, the end. What this software is going to allow you to do is that if you, based on your goals and objectives, need to be at a 70 and you're at a 30, things can be modified. And vice versa. If your risk objective is a 70, but you might need to start using this money in the next few years. Like maybe we need to reduce this down to 40 or 30 or somewhere closer along those lines. And we can pick different investments that can still achieve the desired outcome and significantly reduce the risk, or significantly increase the risk as well too, to get you the goals that you absolutely need. So, and the reason I like having this conversation, Mike, is because I'm unbiased. I've worked at BlackRock, Invesco. I mean, I've worked in the industry for 10 years, and now being outside the industry, I can say, unequivocally, without a doubt, that one, most people need a financial professional in their lives right now. I don't think that that's going to go away. If Tiger Woods can still, going back to the golf analogy, if Tiger Woods can still have a coach, and he's won numerous Masters, numerous majors, and still have somebody that can look at his performance and look at his practice steps and offer advice and tutelage to him, I think everybody needs it. Everybody needs a professional coach, if they're going to save this money and then utilize it for the rest of their life. And I think more importantly now than ever is a time that, we need to be talking about these things as well too. Is there something that you want to kind of, I know people can't, see you or look at your screen right now, but is there something on the website that the listeners can kind of look at or maybe play around or maybe take a tour about that you can kind of describe with them?
Yeah, so there's not, but if there's a better way of doing it, in my opinion, right?
Okay.
If you Google Riskalyze, you'll find thousands of advisors who have framed their website around the concept. So, like for instance, I'm just going to make up a fairy tale name, firm, right? So you're looking for an advisor, and you type in Riskalyze, it pulls up Jameson Wealth Management. On their webpage, it'll have, what is your risk number? You can go through one of the questionnaires that they provide on that site, which is based off of our technology. Mm-hmm. You'll know they'll actually take you through the process I'm describing you, right? They center their practice around this language. And I couldn't encourage you more, if you're looking for an advisor, to look for what I call an advisor that uses Riskalyze, or a Riskalyze advisor for that matter. Mm-hmm. Because I think you'll really enjoy that experience.
Now, is it product agnostic as well too? Like, does it matter if the advisor uses, Invesco, Franklin Templeton, BlackRock? Doesn't matter at all. So,
no, that's important. It's a great question, and I think it's important. Also related, and I'm still thinking about that Barstool comment, but
Dave Portnoy is his name.
Yep. Yeah. No longer the CEO. Is that what you're saying?
I don't think so. I honestly think all he's doing is day trading on Twitter and making content.
It's funny. But one of the most enjoyable parts, and you talk about agnostic, but is when you plug in your portfolio, one of the things that I think the industry has cookie cutter way too long is sort of that asset allocation mindset that, all stocks are created equal, all bonds are created equal. A target date fund, any of you on the call might look in your 401k and it says, I'm going to retire in 2040. I'm going to buy this because they're just going to allocate accordingly over my lifetime. But the reality is that the underlying holdings matter.
Mm-hmm.
And if your advisor leverages Riskalyze and they plug in your holdings, you're going to see that Tesla is a 99 and Apple's a 91 and Verizon's a 76, right? So the analysis is robust and it's down to the security level, which is very, very important, right?
Yeah.
And even bond funds for that matter, right? You mentioned it earlier, like bond funds aren't necessarily safe, especially right now, because if rates go up, there's something called an interest rate risk, right? Yep. And we actually had I don't know if you knew this, Sam, but there was a total return bond fund that got smashed more than the markets over COVID. It was down lower than the bottom, so you have to do your homework is my point. And I think it just brings to the ultimate point that if you don't have time to do your homework, then I couldn't recommend getting an advisor, and in that matter, a Riskalyze advisor, of course.
Yeah, and the reason being is a number of factors. One is because, interest rates are low, significantly low. I mean, who knows where they'll be in the next 3 to 4 years? A number of market expectations are higher, but, they've said that for the last 5 to 10 years as well, too. And all they've done is essentially dropped. There's a unique article that I used to reference in meetings called Pensions Pile on Equity Risk. And what it described is that CalPERS, from 1990 to 2000 to 2010, in order to meet the same, return objectives to pay their pension liabilities of, let's say, 7%, they have to have 50% more equity exposure, than the bond exposure they did in 1990. And that's kind of the framework that, Riskalyze is going to help assess. It's think about buying groceries, this weekend. And this software is going to allow you to look at all the groceries that you purchased, but more importantly, look at every single ingredient in each one of those products and tell you how much fat, how many carbohydrates, all the ingredients of all those products. That's basically what this software does, and tells you that you need to take this out, or maybe you need to put more of this in, to kind of, make the meals that you want to, and the meal being, that retirement framework.
I think you nailed it.
Yeah.
If you're looking for a role, we could use you.
I just noticed, are you guys where do you live? Are you guys in Auburn?
Yeah, so we're our home office is out of Auburn, California, north of Sacramento. Well, yeah, you would know that.
Okay.
I'm siloed here by myself in Pittsburgh. We got a small office in Philly, and then we got a small office in Midtown Atlanta.
So what Mike and I used to do in our previous career was meet with financial advisors and, just provide value-added solutions. But, how we got compensated was, I'm going to say this a little tongue-in-cheek, trying to convince the financial advisor to put their clients' money in our products. Now, the financial advisor, the assistant, the firm that the financial advisors work at, they're going to do their best to level the playing field, so to speak. And so you can't, just because Mike is handsome or Samuel is handsome, is not going to be good enough if the product does not fit the mold for the actual client that he's trying to serve. So the products have to be good as well, too. I think that, a tool like this kind of even levels the playing field even more. And I think that, from the clients that I used to work with, maybe I sold a different product being on the annuity framework when I was 100% out in the field. But I think, some of the ETFs, some of the mutual funds have a really nice framework, because you can kind of strip off the wrapper, so to speak. It doesn't matter, what firm these products come from. You can strip off the wrapper and just look at kind of the ingredients inside of that portfolio and see if it makes sense when you're constructing it for those clients. So that's kind of why I've always gravitated to a product like this. And I know some firms are coming out with their own proprietary solution like this to kind of run quant-based models as well, too. Does Riskalyze partner with every mutual fund company, essentially? Or do y'all have like assets under management, or is it just like a third-party solution?
No, it's a third-party solution. So
Okay.
we do have the universe of securities, including, and this might be good for your audience to know as well, is alternatives. That's going to be a big conversation you'll be having with advisors, specifically when you're not going to get the income you might be needing from bond
So
side.
explain what alternative investments are.
Yeah. So you got typically you when you think of an investment portfolio, you think stocks and bonds, right?
Mm-hmm.
There is, I wouldn't say upcoming. It's pretty prevalent right now, but especially alternatives would be something like BDCs, like oil, limited partnerships. Alternatives might be,
I would say to keep it simple, REITs, like anything besides stocks and bonds.
Yes, anything.
Yeah, essentially. And go ahead.
No. You were nailing it. Anything besides stocks and bonds, like you could call it art or car collection to non-traded REITs, real estate investment trust, to real estate, to BDCs, there's new products coming out that seem pretty prevalent. I don't know if you've been talking about them, Sam, but structured notes, buffers so you can protect. I mean, we could go down a whole rabbit hole.
The list of alternative investments is long, and the reality is that I would say most financial advisors are utilizing alternative investments in some capacity, because most mutual funds, if they're not alternative focused completely, they have some small exposure to alternative investments, unless they're a pure stock or pure bond portfolio. If they have kind of a mixed bag, let's say they're investing in emerging markets, they have some exposure, whether it's the companies that they actually purchase and those being equity type securities, they have an exposure that is correlated, which means it kind of works the same way that some other investments do to some of those alternative investments as well. So again, just another endorsement from somebody outside of the industry, from a third-party platform that financial advisors should be utilizing. And I'm not getting paid for this. Mike was gracious enough to spend time with me today just to speak to all of my listeners on the podcast today. Just throwing that disclaimer out there.
And of course I can't help myself, right? So, we talked a lot about this risk number, right? And how we score individual stocks and bonds and all that stuff. But we do, like I said, we score alternatives. So we put a risk number to tell you that, hey, that non-traded REIT's a 50, right?
Oh, wow. So do y'all do that for all investments?
Oh, yeah. Yeah. And
wow. Okay.
And that's what makes us, super compelling in the industry, is because we're putting everything on the same playing field, and everything has that language, that risk number language. But better yet, you talked about correlations where, you could actually bring in a riskier security in your portfolio, like a REIT that's maybe a risk 99, but it overall lowers your household risk number.
Exactly.
So because it doesn't correlate as much. So I might be getting into the weeds a little bit there, but it's pretty powerful from that perspective.
Yeah, and I think that, that's important, because I think that's where the makeup of the portfolio construction as a whole comes into play. I think a lot of times, especially for newer financial advisors, I'm not going to ask you your age, but I'm going to just say I'm under 35. The advisors that are in that demographic, they typically have, one client that gives them one account. Let's say it's a sizable account, whether that's six figures or not. It's one of their retirement accounts, and they have another one with somebody else, or maybe they do half of it themselves and they'll give you the other half because they don't fully, quote unquote, trust you. I'm doing air quotes for everyone that's listening. They don't fully trust you with all of their money. And I think that works against the retail investor, because having a holistic approach, a holistic view, and seeing kind of where all the pieces to the puzzle are, really help you make a more informed decision making when you're putting that portfolio together. Just because, like Mike said, you can have one individual security that's a 99, the most riskiest security, but because it behaves differently than some of the other things in your portfolio, it can have a less riskier effect inside of your portfolio that you actually need. And so I think that, another endorsement, for the tool Riskalyze.
It's It's funny because, I have family that, don't have advisors that leverage our technology, but they just love this conversation around this risk number all the time. So they ask me, oh, what's BP's risk number? Or what's, so
Wow.
it's catchy, and that speed limit, people really want to know.
Are you able to tell us for the listeners right now, if I gave you some securities, what the
Yeah.
risk numbers are? Okay. Let's see. Well, you already told me Tesla is 99. So what is Facebook's risk number?
Second, pulling it up.
Okay. I'm just going through my watch list right now.
There you go. Let's see. Facebook is 98.
98. Okay, that makes sense. Okay, what about Southwest Airlines? Love. I'm going to say that's probably, it has to be 85.
96.
96. Okay.
Yeah. You'll laugh at something too. I got to tell you, like,
yep.
With each security portfolio, all your portfolios, we also run a GPA analysis, right? So think of it like a grade point average, where we'll say like Southwest is a 3.1 on a 1.0 to a 4.0 scale. We actually go out to a 4.3. So like in school, right? So a 3.5 means you're an A plus student,
right?
And we apply that to the securities and portfolios as well. So
it's like your buy rating. Like if this is an A plus stock, is that the way that it?
Yeah, think of it like it's a Sharpe ratio. Risk
adjusted. Okay, gotcha. Yep.
So Southwest is a 96, but it has a GPA of a 3.1. So it's about an A, right?
Yeah. Yep.
Find maybe a little bit better than that, but.
Yep. What about Realty Income? Ticker symbol is O.
That's a 90 and a 3.8 GPA.
Okay. So, obviously, my portfolio is very risky, but like I told you, I'm under 35, so that makes a lot of sense. What about At&T? That's a, blue chip, dividend aristocrat. It should be pretty stable.
At&T. What's the symbol?
T.
Oh, shoot. I should know that. 83.
83. Okay.
It's on the dean's list too. It's a 3.5.
Yeah, there you go. Wow, so I've always had some familiarity with Riskalyze, but I didn't know that you could have a risk number for the individual securities. I wish there was a way that, I could do it and, just use it, for my portfolio and kind of put it together, as well. Maybe I need a financial advisor.
Hello, Joe. We can talk offline.
Yeah, absolutely. Well, I mean, I know that we've talked about a number of things. Is there anything else that you kind of want to let the listeners know? I'm going to place this on LinkedIn and all the social media platforms. And I think that, you and I both covered enough information for, financial advisors as well as retail investors to kind of gain some insights, whether it's, doing business with their clients or doing business or investing for themselves as well, too.
Yeah. So, one of the things that as you're talking to advisors, I think the more important things you could ask your advisor and challenge them on, ask them, what is when it comes to risk, what is your process? Right.
Great question.
And one of the things that you should be wary of when talking to an advisor, I would say, are those that focus on returns, right? Because if I say to you, Mr. or Mrs. Client, we're going to shoot for an 8% return in this portfolio. Okay. The problem with doing that is if you look at the markets over the last 25 years, it's come within 100 basis points of its own average, which is 1% of its own average once. So having that thought process and advisors focusing on returns is sometimes, they're setting you expectations that they're almost more than likely never going to hit. So, position yourself with advisors that are risk first and care about your tolerance and can, your downside and really focus your conversation around those advisors, I would say. So
is there is there a framework for the portfolio versus a benchmark with the same type of risk tolerance? So I'm going to say like SPY is probably, maybe a 90, I would assume.
That's actually what I was telling you on the front end when we were talking about the questionnaire, right?
Okay.
Pinpointing to the market. The market's a 77 right now.
Okay.
SPY.
Okay.
Right? So gives you some framework.
Yeah. Absolutely.
Yeah. You can plug in any benchmark. You can plug in the ag, the bond index. That's probably a 32 or something right now. I think I might see. So
yeah, I'm taking a lot of risk in my portfolios, which I'm okay with. Like my whole ticker, like I have a watch list in my office that I'm looking at, and I'm just thinking Realty Income is one of my least aggressive portfolio holdings, and so that's pretty risky. I mean, the whole thing is there, but I also have 60 years, till retirement, or maybe not 60, but another 35 years, until I'm, in my 60s. Mike, where can they find you, or does Riskalyze have a social media channel at all?
Yeah, we're all over the place.
Okay.
You can find me on LinkedIn. My last name's Sefscik, S-E-F as in Frank, S-C-I-K. Feel free to shoot me a message. You can also find Riskalyze on LinkedIn or riskalyze.com. Twitter, Aaron Klein, our CEO, is his name.
Yeah, and he's interactive as well too. He's not. I know your PR department may have some challenges, because a lot of CEOs, they tend to get in trouble. But he'll respond to you, at some point, maybe potentially. I see that he has a few tweets every now and then, though. So
I definitely don't have his presence. That's for sure.
Well, thanks again, Mike, for coming on the show. We really appreciate your insight and also educating us and the listeners about, Riskalyze, but more importantly, how to build portfolios and have those conversations, with money managers or that are taking care of our money, as we plan for retirement. So thank you for your time so much, man.
No, I really enjoyed it, Sam. I'll make sure I tell TJ I talked with you too. So
yeah, absolutely.
So
all right. Well, thank you all for listening.
Thanks, everyone.